think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, we're back at the Money Level Show. It's your host, Daryl Thomas, and today I'm here with a new guest by the name of Alan Galecki from Germany. And I learned about Alan through, he sent me an email, and he does a lot of amazing work with asset valuations and stock valuations and such. And so, how you doing today?
Hi there, Daryl. Thank you very much for having me on your program. I'm doing fine and I'm happy to be with you.
Yes. You have a lot of knowledge, which our audience is going to, experience and hear from you. What was kind of your backstory? How did you get involved into investing, and what drew you to doing this?
Yeah, it was quite a funny story. I had no direct connection to investing at all. The only investments I had as a growing up person was my banking account in times when there were interest rates. And there was a time when I realized I don't trust the public pension system, and I have to take the destiny into my own hands. And this is how I stumbled upon stock investing. And the final trigger was when a colleague of mine in lecture at university was trading some stocks under the desk. And then I saw, this must be interesting, and I want to get to know more about it. And so I started reading books, watching TV programs about stock markets, economy, reports, and this stuff. And the best lessons I had were mistakes I did myself.
Mm-hmm. That's good. That's good. So you mentioned that taking your destiny in your own hands, and not relying on the public pension system. And so we have a pension system here. I'm a part of a pension program, and I've done some videos on the status of each individual state, in terms of where they are with pensions. But I mean, it just looks horrific, in terms of our government debt and deficits. And some of the states here in the United States, like, they're underfunded by over 100 billion in their pensions, and people are going to work for a number of years, 20, 25, 30 years, and then they get a letter in the mail stating that their pension wasn't funded. And so, which is very horrific. And I don't want to dedicate my life to a job and then not receive a pension. Is that somewhat what you're feeling there, or what's kind of the macro setup for pensions there?
Yes, it's exactly the same. On my side, I don't want to rely completely on the system. If I get a penny out, it's fine, I will take it. But the basic story here is we have an industry that is being deindustrialized, and we have no own energy production, and Germany is on the way down. Clearly, the pensioners are receiving less and less money for their retirement and hard work, and it's really a sad story. I remember in the 90s, politicians were promising and telling, your pension is safe, don't worry about it. And every time you receive your yearly report, what to expect, there are lower and lower numbers. And also they started taxing the pensioners, which was a no-go in the past. So it gets less and less attractive, and you have to do something yourself.
Yeah. Is there some type of social security system there or anything like that? I don't know if that's happening over there or.
Yes, it's a public system. As a worker, or active in the working life, a person, you are automatically subtracted some fixed sum, which is put in the public domain. And it's simply, you don't have any control about it. It's not based on your will if you want to participate or not, but it's just as it is. The government takes it and distributes it automatically to the current pensioners, and everything you pay in will get worth less over time. And then you also have inflation, which is another separate topic which comes on top of it all.
Mm-hmm. Yeah, definitely. I was going to actually ask you about that. What is inflation looking like over there?
The official rate is not that bad. It's somewhere around 4%. But if you compare prices in the supermarkets, it's of course not 4%. Maybe in just a in just a few months, it could be 4%. The price increases in the last 2 years were shocking. For example, cottage cheese. I'm often eating it for breakfast. It tripled in price. You can tell me that's an increase of 4 or 5% a year.
Mm-hmm. Yeah, definitely. That's the same thing here. I think they just changed how the CPI, consumer price inflation, is calculated and such. And so yeah, it's a lot of games being played. And then is your central bank, because y'all are part of the European
Correct. Central bank, yes.
Central bank, yeah. So and they're hiking rates as well, correct?
Yes, they are hiking rates, but banks are more or less reluctant to pass on the higher rates to customers.
Yeah, gotcha. And then and they follow like the direction of the Fed or something like that. Do they like follow like the Federal Reserve and then make their decisions, or are they kind of like independent in how they make their decisions?
Officially, of course, they are independent and deciding on a highly professional basis, evaluating their data. But you can be sure that they look overseas what's happening there, and they must look to not allow the spread between your interest rates and ours to be too big, because it would, of course, have a negative impact on the currency exchange.
Yeah, exactly. Well, yeah, that's good. Appreciate you chatting that me understanding the macro situation over there as well. So it's really good, because a lot of times I just get so caught up in the U.S., but I like to hear about other markets. And so you do a lot of valuations, and one of the valuations that you sent me was on Petrobras. And I'm an investor in Petrobras. I have the common shares, and then I have the I forgot what the other type of shares it was.
Preferred shares.
Yeah, preferred shares. And so it's escaping me. I have both, but you made a really compelling case for the preferred. I think it's the preferred shares.
Yes, Class A or preferred.
Yeah, Class A. Yep, preferred shares. Yeah, got it right. And you mentioned that the government owns a lot of shares, and like I think it was like almost half of the shares or something like is owned by the government, even though they have a new president that may be environmentally friendly or something, and may issue some type of taxes. There's risks there, but you mentioned there's a lot of potential for rewards. And so share with us your assessment of Petrobras.
Yes, happy to share it. Every government and every politician is friendly towards the environment officially, and what they do in everyday life is another story. Concerning Petrobras, I think there is more type of a lip service towards the Western world. You can also observe it from rather more Asian countries, because these we can agree on poorer countries. Developing countries are more dependent on this energy, less on the consumer side, but more on the production and selling, exporting of energy to the Western countries. And what the thesis I created while researching Petrobras was that I saw that, as you mentioned, there are two types of classes of shares. Actually, it's the way that the government owns slightly more than half of the voting rights, but they own less than half of the economic rights. This means that more than half of the dividend is distributed to someone else in the government, and every president, no matter what party he comes from or she, they were always unhappy with the situation and were also sometimes frustrating and angering investors or frightening investors about potential dividend cuts to keep the money more inside the country and not to let the Brazilian people pay for the dividends, so to speak. That was the story they were portraying, and Petrobras a few months ago announced a buyback program, but interestingly, they only started to repurchase the preferred stock, and because government is barely invested in it and it has no value for the government directly, it's interesting to observe that by retiring and taking them out of the market, of the float, they can increase their entire or their relative stock. And this means that they will receive from the same paid out sum of dividends, they will receive a higher share directly into their coffers on top of the taxes they are already receiving. And they are also benefiting clearly from the dividends themselves. That's why I'm rather sure that a bigger cut is rather unlikely. And what they announced with their strategic shift was it was a cut compared to last year. This is clear, but it has more to do with lower energy prices. We had this tremendous spike during 2022, and I calculated that at current oil price levels, we can expect around 10 to 15% per annum, which is a nice sum. It's especially dramatically higher what you can get from your US counterparts.
Mm-hmm. Yeah. I mean, because if you're investing in like Exxon or Chevron, I mean, you're getting what 3-4%, something like that, and so and the share price is a lot higher. Obviously, there's a lot less risk. I mean, with just the structure of the U.S. and in terms of like, taxes and such like that, we have this whole democratic process that you have to go through in order to even take from companies like that or or regulate and such. And so so I can definitely. It's the Rick Rule comes on my channel. He says like, "Hey, own Exxon and such," and like, but it's like, I'm just like, man, I get more bang for my buck with like a Petrobras or Ecopetrol, like where I'm getting a huge dividend, but obviously you have to like manage risk and such, and so definitely understand that.
Yes, risk reward and managing risk is always part of the game. Every serious investor has to decide for himself, is it worth it for me? Do I understand this case? And am I willing to get into this?
Yeah, definitely. Yeah, definitely. So, I mean, oil just in general, I mean, from what I know from last year, that the energy problem in Germany after the Russia-Ukraine invasion and such, like, just as this kind of a macro question, but what did you experience there? Like, what was that like for you all there when Russia would cut off some of the Nord Stream pipeline, or reduce the amount of energy was coming out, and then I heard like there's like taking down of nuclear plants and wind farms and building coal plants, and like it was a lot of information I was receiving about Germany, but you live there, so I wanted to get your take on like what's kind of happening in the energy sector in general over where you're at.
Yes, that's not a simple topic to talk about, but I try to break it down. Concerning oil and gas, everything has become dramatically more expensive. That is out of question. The more so if it's not only putting gas in your car, it's also heating at home, and oil is as necessary as a first step process product for packaging material, for transportation of stuff to the supermarket and to your home, and so the whole value chain was affected negatively in the sense that the prices were higher. And on top of that, the German government also has initiated carbon tax, but this was not a problem of this year. It was already 1 or 2 years ago. But one factor here, one factor there, a third factor here, and they are taking more and more money out of the pockets of people, and they want to try to make fossil fuels as unattractive as possible, as uneconomical as possible for the everyday consumer. Of course, it's also no secret to hide the uneconomical structure of the renewables. Wind energy is a complete disaster here, and with solar energy you can use it at best half a year when you have late spring, summer, and early fall. But in winter you can forget it. And we had even the phenomenon, it was too hot this summer, so that these panels also were not functioning properly. So this all leads to the effect that you always need some type of baseload energy. And because these renewables are so unreliable, some people also calling them unreliables and not renewables. The pervasive effect is that in 2015 or so, it was we had coal production reduced to below 10% of our energy mix, and last winter it was more than 30%. So with ever more wind farms and solar panels, you also have to have more gas and coal consumption, because nuclear, as you might know, is a no-go topic here, at least publicly, and they switched off in April the 3 last remaining ones. So energy is always here a rather fragile topic, but luckily we had no bigger outages and blackouts or scenarios where people were left stranded without energy supply.
Mm-hmm. Yeah. Yeah, that's rough. And so is that how, I mean, because obviously, you're more into natural resources investing right now, and that's the sector to be in. So when you noticed those things, was that kind of something that was like, okay, well, let me look into natural resources? Like, how did you get introduced to this specific sector? Because it's an unloved sector. And it's
yes, it is.
It's mostly a lot of old guys that you hear it from, and so how did you get introduced to this sector?
There are 2 main pillars, I would call it. The first one is we all know that energy, and no matter what type of energy, has always been a cyclical business, and I'm sure it will continue to be cyclical. But we have a new phenomenon now that, due to this ESG, I don't want to say necessarily nonsense, but brainwashing and bureaucracy, and nobody wants to publicly be brought into direct relation with fossil fuels, at least not when you're managing money. They are either not allowed to invest, or they are only doing it symbolically or beneath the top 10, so that you don't have to show the positions on the fact sheet. And this led to the companies not investing much in the sector, at least not when it comes to expansions. They sold unprofitable projects and focused more on costs. I remember that Total Energies, this is a big oil company from France here in Europe, they had production costs of between $80 and $100 at the top of the last cycle, which was in 2014. And now they have only a third of it, because they scrapped all their investments and unprofitable projects. And they are not only they, also their peers in the sector are only doing more or less maintenance work and barely investing into more growth. You can also see it in your US shale producers. They are investing, they are also increasing some capex, but the output is not growing. It's becoming slightly more expensive, but it's not more oil is coming to the market necessarily. And this more or less puts a flaw under the story, because in earlier days or in other older cycles, when the mood was good, when sentiment was good, when the upswing was ongoing, they started to invest even more, typically pro-cyclically, and this led self-explanatory to too much supply, to oversupply, and this crashed prices, crashed their projects, led to write-offs and so forth. And this time I do not observe this rather typical cyclical phenomenon. And on the other side, if you're investing in energy, you also have a geopolitical hedge. This should not be the main investment thesis, of course, because sad things are happening on the world. But if you know these two things, then at least it's in my case, the energy sector has become what the old consumer stocks were in older cycles. Stable, reliable dividend payers, and interestingly, many of the energy companies also have rather clean balance sheets, what in the past also has not always been the case.
Yeah, and that's definitely, and that's why I said, old guys, funny, but just like people that experienced the last, bull markets in energy, and just hearing those stories. I mean, with uranium, oil, all of these different companies, like they made some massive amounts of capital, during that cycle. So you mentioned coal. So what's your take on the coal sector, coal stocks? I mean, I think that's probably one of the most hated right now. What's your take on coal stocks in that specific sector?
Yes, interestingly, coal is even more hated than oil and gas, but you cannot substitute it, at least not in the short to middle term. That's completely unrealistic, because you have to take big amounts of money into your hands to build alternatives, but I don't see this happening on a grand scale here. This is more promising and presenting dreams, but the reality is somewhat different. And I see, interestingly, coal as the new tobacco. We know the story when everyone hated tobacco, smoking rates were declining and are still declining. And everyone was saying now tobacco, also with the new legislation, they were forbidden to place ads to prevent younger people from starting smoking. But tobacco was one of the best, if not the single best sector over the last 20 to 30 years when you factor in the massive dividends, because no one wanted to invest in them, and the yields were really dramatic, and they also repurchased lots of shares. And with coal, we are seeing a pretty similar setup, but tobacco was not really necessary. It was, of course, people were addicted and they were buying, they were loyal customers in a negative sense. But you could theoretically at least do without tobacco. It's not necessary for the broader population, but with coal, you need coal. Thermal coal, you need to produce electricity, and met coal is, of course, needed to produce steel. And what is even more pervasive is all the advertisements for renewables, whether it's windmills, it's water projects, you need steel for all this stuff. You need even more steel than you needed before, and you can only produce steel when you have coal, and this leads to an even higher demand for coal. And you can be sure that India and China, as two of the biggest steel producers over the next years, will not care about this ESG stuff and how to replace coal, because they want to bring their population and their economies forward. So even if we here in Germany should indeed save somewhat of coal, it will come on top in Asia in several amounts back.
Mm-hmm. Yeah, definitely. And so, are there any specific coal stocks that you're looking at now that seem pretty interesting to you?
not on the side of thermal coal. I have to do more research in this subsector, but when it comes to met coal, the type that is needed for steel production, I'm rather looking at the US market because their legislation is, I would say, rather softer than in Australia, for example. There's arch coal, there's alpha metallurgical resources, and there are also, I think Peabody is also working in the sector. When you're looking from a top-down perspective, I think it's not even that important which one you will pick. It's only interesting and worth to know that all of them have now clean balance sheets. They don't get financing, external financing, because banks and bond emissions are tough to get. So they are forced to finance themselves from cash flows and to have the finances in order. And on an even more extreme level compared to oil producers, they are investing even less into their sector because they know that new builds are not permitted or very tough to get a permit to build a new mine. And they are also only doing more or less maintenance, taking off the ground what is easily available, the low-hanging fruits, as you are saying. And ironically, these businesses have even become asset light, which was completely unthinkable in the past. And when you see the low valuations of single digits enterprise value to free cash flow, for example, this is my favorite metric. Dividends is not a big topic. They are more focusing on buybacks. But if you hear that they can easily repurchase around 10 or even 50% in a single year, depending on their buyback program, these are ridiculous numbers. And for stable businesses that are supposed to die, but they are not dying, they are still needed, their products are needed, and you can be sure that at the end of this decade, coal mines will still be around.
Mm-hmm. Yeah, that's interesting. You mentioned Peabody, so at the COVID crash, I bought Peabody at, it's like $3 a share or something. Yeah, and I didn't even know what I had in my hand. I mean, like, I was watching a gentleman by the name of Trader Ferg, and he mentioned it, and so I was like, oh yeah, this is cool, but I didn't really understand like the natural resources sector as much, or like the case for it or anything. So I sold it when it hit like 11 or 12 bucks, and I mean now it's sitting at $24 or something, and I'm just kicking myself like, man, I didn't know what I had in my hand, you know. So,
but a nice return nonetheless, and many people even don't know that coal did perform on average better than the big tech stocks did starting from 2020 onwards.
mm-hmm. Yeah, definitely. I also had the stock. It's called NRP, natural. I forgot. I think it's like a combination of something, but they do coal as well. And so that stock went from like $20 to like sitting at 60. And so yeah, it's sometimes you gotta learn what you own, you know. And so. So I want to transition to, I want to talk a little bit about uranium as well. Obviously, Germany shut down the nuclear reactors, which seemed to make it more bullish for you for uranium, because we already we still have high demand and and low supply. And so, what are you looking at in terms of in terms of uranium?
I want to keep it rather simple, and that's why I decided to go the way with Yellow Cake. This is they have the same business model like your Sprott asset counterpart has. They are only buying physical uranium, storing it somewhere safely, and waiting for the uranium price to appreciate. Although you can maybe not achieve the same returns you could have with a junior miner, at least theoretically. The big advantage I'm seeing is that you don't have to worry about all the problems from the environmental side, but also it's not that easy to switch on a mining operation that was dormant in the past, like Cameco, for example, had. I guess they were saying that it would take 18 months to from the dormant status to full production again for their big, I think it's the Cigar Lake mine. And you can always have accidents that are unexpected, and I don't want to be involved with all these everyday problems, decisions, so that I'm taking the easy way. And we are now somewhere in between $70 and $80 for uranium, and we can observe that the first producers are slowly starting to think about doing more projects to invest more into new builds or expansions. But we also know that this will take years for new supply to come to market, and not only the fact that new supply will come to market is important to know, but also we have a gap between the supply and demand of about a third currently. And first you have to close this gap, and it's unlikely that this will happen over the next years because these projects take simply too long. One company I would keep in mind is this. They have this big Canadian project. I think it's the Arrow project mine that is this on itself is as big as a Cameco as a whole company is. If they should sometime indeed come online, this could lead to an oversupply. But I think we are talking here more about the next decade, not this one. But until then, the facts are clearly in favor of higher uranium prices, because the incentive in the past was not there, and even the most profitable and the leading businesses were underwater, and this was not a sustainable situation. We are away from this trough, luckily, and this all is even without thinking about additional demand that is coming on top. So this is another catalyst that's rather in favor of all this uranium thesis. And as I said, I want to keep it simple, not worry about the things, enjoy the ride, and it looks good until now.
Yeah, definitely. And we were talking offline because you had I recently saw a article that you did on Barrick Gold. The gold miners are very much out of favor. They've been getting slaughtered, and so I'm trying to keep some optimism in the sector. Even though I hold physical gold, I do hold some exploration companies as well as some of the miners, but they're not a huge amount of my portfolio. What are you seeing there? Gold, silver miners, and then if you have any thoughts on platinum, palladium, I'd love to hear them.
Yes, okay, let's take it case by case. Certainly you have also heard many of the gold bulls telling, if you want the extra kick for your portfolio, you need to buy precious metals miners, because they are levered bets on the spot price. But if you look back over the last 5 years, you will see that most of them are indeed underwater, and they did not manage to beat the spot price, even though the spot price itself is higher than it was 5 years ago. This is tough to swallow first, but one has to also know that production costs have risen disproportionately on an even grander scale. And this, sure, because of inflation, because of higher energy prices, but also due to tough to get by labor. Many companies are complaining about it's not easy to get skilled workers, because you unlike in a restaurant, you cannot put anybody into this job. You need certain knowledge and skills, and yes, this has squeezed obviously margins, and that's why I think that most of the producers deserve it to trade way lower than they did before, and even more so if they diluted their shareholders. But these are topics that many are not looking at. And the gold and the silver subsectors both are very tough. Of course, you could play the pretend safe bet by going by the big names. You mentioned Barrick a few minutes ago, but I personally don't like Barrick. It's the second biggest producer currently, but it's already only 50% of what the new Newmont is after their recent merger with an Australian entity. But their history of execution is rather weak. They have done some M&A with a dilution at the bottom, which was not really favorable. They promised massive synergies and big production increases, but if you compare what they said 2016, 2017 around, and then every 1 or 2 years again, they already lowered their production, their most recent production guidance by a third compared to what they had last decade. And this is not really promising. And on top, Barrick is a very complex entity. It has almost all of its projects are joint ventures with partners. And they also don't have even the lowest production costs. So it's okay-ish in the bull market. You won't lose, but it's not what I'm looking at. I have the ambition to find the highest quality, and in this sector, this is first and foremost a company that has the lowest production costs. Then you have to have a geographical security as best as possible. I must admit I haven't found a prime solution in the gold sector yet. I'm still researching and digging.
Quick question:
Yes.
I remember back in 2020 when Warren Buffett bought Barrick Gold. Did he abandon ship on that, or what? I mean, he bought it at like $28.
I must admit that I'm not even watching Buffett that closely because he has other motives and other luxury problems than we normal people don't have.
Yeah. He bought it at, I think it was close to like $25 to $28 or something, and I think he may have abandoned ship since then. So yeah, I was just saying that in relation to what you're talking about with Barrick. But yeah, proceed with the gold miners.
Yes, and unfortunately, there was a company I liked very much, but it was taken over by Agnico Eagle Mines. It was called, I've forgotten the name, but there was a Canadian company. It has ridiculously low production costs. It had 2 mines in Australia and 1 in Canada. And it was one of the very few companies that was that had not only a bull run, but it even, I think it quintupled or something like that in a time when physical gold or spot gold was going sideways and the competitors were going south because it had such absurdly high margins. And these are the pearls I'm looking for, but unfortunately it was taken off the table. And with silver, it's an even more dire situation because there the gap between production costs on average and the spot price is even lower. Many companies are presenting their all-in sustaining numbers, but this does not include their growth expenditures. And if you are already on the all-in sustaining basis close to the spot price, it's only a matter of time until you deplete your reserves because you don't have the financial means to spend to replenish your reserves. And I had difficulties to find a really competitive name. Your biggest US silver producer is Hecla Mining, I guess. It has a market share of 40%. It's also one of the biggest silver producers worldwide, but even this company is heavily diluting its shareholders. It posts only rather weak financials. Cash flow is okayish, but it has an absurdly high valuation for rather nothing and a high debt load on top of it. So that I'm also not happy on this front. And the counterpart to Barrick Gold from the gold sector is, I think, more or less Pan American Silver. In silver, it's at least a household name. But interestingly, Pan American is even making more money from gold than from silver due to some recent acquisitions. But also this company, despite being so big, having so much projects in Latin American countries mainly, they also have tough or weak results. Margins are weak. And this is also a name I would rather avoid. As a rule of thumb, I would say don't go just by names or what you hear on different platforms, but you have to, at the very minimum, look at their cost structure and try to figure out a pick where margins are sufficient enough to weather a storm and be at least prepared for a temporary correction, because it can happen that you have a promising pick, but when the prices go down, management maybe panics because their cash budgets are too tight, and then they are forced to do a silly capital raise at the bottom, diluting you and preventing you from participating fully in the upswing that comes sooner or later again. So always look at production costs, pick the ones with the lowest ones, even if their names are not that well known, and maybe if they are way smaller. But playing it safe on this front is also rather the better strategy. Winning by not losing, as they say.
Alan, we gotta have you back on, because I got a lot more questions for you in terms of other sectors and such. But just as we need to close out, I want to get your take on the royalty and streaming companies within the precious metal sector, and then as well as if you have any thoughts on platinum and palladium.
Concerning royalties, I cannot contribute any meaningful content, because this is a sector I've not spent time on. And regarding platinum and palladium, I was thinking about maybe if there could be a supply-demand imbalance, but unfortunately, most producers or most tradable producers are active in South Africa, and there the political risk is too high for me. And also, they have problems with their biggest state-owned electricity producers, and also with their transportation company. I know this also from a coal producer that was suffering from these issues. And this way, I'm just watching this sector, and I'm not sure whether it will unfold as they are pitching their stories.
Yeah, it's kind of challenging, because it's like, palladium, it's over 50% off of its highs, and I think just the other day it had hit below $1,000, and so.
Yes, both these metals are mainly, or for a big part, used in combustion engines. And I was thinking about writing a slightly provocative article whether EVs will not fail, but take way longer to establish, especially for those that don't have decent charging possibility right in front of their house. Because if we are honest, only a minority of people can A, afford these cars, and B, have the possibility to load them up without driving to faraway locations. I think in the US it's rather better developed, but here in Germany you can rather forget it. We are years behind, and it's not easy. I could not imagine myself to buy an electric car at the current moment. So I thought platinum, palladium, could this maybe have a short upswing again due to combustion engines staying longer in the game. But as I said, due to this South Africa situation, I'm not so sure whether this would be a good play. But if you pick a company and due to some supply constraints, the price goes up, but you have exactly this one company that is affected, you will not have any advantages of your investments. That's why I'm sitting on the sidelines here.
Yeah. And it's I mean, we also have, you know, the recession sentiment is still in the air, and obviously during recession, like, people aren't buying as many cars and things of that nature, so that could also impact the price even further.
Yes, this comes on top of it. Yes.
Yeah. You know, so it's kind of it's kind of interesting. I mean, just seeing them that cheap. I mean, even we saw, you know, the price of rhodium just skyrocket over, you know, during the pandemic. I mean, it went to, I mean, close to 20,000 an ounce or something, and
Yes,
now
this was insane. Yes.
now it's back down to like 4,000 or something like that. But you know, so yeah, it's kind of interesting. I do think that, you know, a lot of the EVs will need a lot more metals that haven't been mined, and I mean, one of the issues with the EVs is these fires as well. I mean, there's these videos of these electric vehicle fires, and they're pretty intense, you know. And so
yeah, I know we had a burning ship here at the Dutch coast, and it took them days, if not even more than a week, to handle this burning ship, and they did not know whether it would sink or whether they'll be able to pull it to the coast. It was yes, really dramatic, but luckily they succeeded.
Yeah, definitely. And just before we close, any thoughts on copper? I mean, copper is obviously needed for this, you know, transition to clean energy. Copper does get hurt significantly in recessions. But yeah.
Yes, indeed, I have a non-mainstream view on copper, because I think that copper, at least in the short to medium term, will rather disappoint. I'm not seeing this ultra bullish picture for several reasons. First of all, the Chinese demand is the single most important one. It's not EVs or cables or anything around this renewables, because the quantities are for Chinese properties were way higher, and it's not a secret anymore that they have issues in their property sector. Then should a recession come, don't know whether mild or harsh, it's rather safe to say that and paired with high interest rates, that new building projects will be rather postponed, and this will pressure copper on this side, on the demand side. And on the supply side, the only thing I'm seeing is investments, increase output. And so I'm afraid a little bit that it could overshoot on the supply side. So it's not a convincing case for me. I need a scenario where producers are pushed to the wall, where production costs are only slightly below the market price. But with copper, this is not the case. It would to trade way below $3 to squeeze margins in a way that first projects would be put on care and maintenance, and where supply would be dramatically reduced. And from what I have observed and read also in publications, is that the best situation for a new upswing is when the supply gets reduced on in a dramatic way, so that when the demand comes, which is more dynamic, I would say, because theoretically demand could switch back on from one day or from 1 week to the other. With supply, this is not the case. If the decision is made that supply is turned off or turned down, then it will take at least a few months for them to be brought back to market. And then you have these big swings up, and I don't see this in copper. I'm rather afraid that we will have, at least for a short time, an oversupplied situation, so that I'm staying away. And one last thing on copper, On a conference a few months ago, Elon Musk said he was questioned whether there's enough copper for all these plans, especially regarding electric vehicles. And he said, of course, there's enough copper, and they plan in the future to reduce copper in their cars by 3/4, by 75%. And to be honest, I believe more in the capabilities of a physician like Elon Musk than on any agency hiding behind acronyms and publishing any projections that don't stand the test of time and that have to be revised all the time. So copper is, I would rather be cautious with it.
Okay. Gotcha. Well, Alan, I appreciate you coming on and sharing, a wealth of knowledge and perspective on the commodities and natural resource sector. I'd love to have you back on to talk about some of the other sectors that you write about. And but where can people find more about you, and what are some of the services you offer?
Yes, thank you, Daryl, for having me on. I'm happy to return. If you like to, I have an own website. It's called financialengineering.net. Financial engineering, maybe in brief. I am an industrial engineer who turned into financials. That's why I call it this way. And I have a free publication service where every Thursday I'm writing columns on different topic. In the past, it has been more on resources and also on mindset, but I'm rather free here to write about everything that has any the connection to stocks and investing. And I also have some premium services where I'm publishing to my subscribers my best stock ideas that I think have the best risk-reward ratio. And I'm doing this all based on simplicity and common sense. I don't want to engage in complicated stuff in complex situations. We mentioned Barrick recently. That would be too complex. I need easy to understand, easy to overlook cases where I can, in a few sentences, explain to you what the basic thesis is. And on top of it, a healthy portion of some gut feeling, because this is something I learned to cherish over the last years. You can do the best analysis by digging into numbers and reports you want. If your gut feeling is telling you, wait a minute, you better should wait.
Yeah, definitely. And I appreciate your writings too, because you do simplify it for the average investor, the retail investor, and make that information a lot more clear. So thank you for coming on, and looking forward to our next chat.
Yes, thank you very much, Daryl. Your claim, your motto is think, act, and prosper. And wanted to say to your viewers, don't think too much. Please act by following Daryl's channel and prosper with him. His content is great.
Thank you. Appreciate that.